All right, today's bank is CNB Financial Corporation. They're located in Pennsylvania. It's a ticker of CCNE. They've also got some preferred shares. They're about 7.125% fixed. Those are publicly traded as well. It's a fairly small bank, about $5.8 billion of assets, at least in the universe of publicly traded community banks. It's got a market cap of about 500 million, so on the smaller side of the ones that are in our database. We can see the stock price. It's had a recent run up over the past week, and that's been the case for all banks over the past week. So we're looking at a situation where now a lot of the banks are priced a little bit higher than they were, before last week. So we're sort of having to consider, are we willing to pay higher prices for these banks now? And so it's not just CCNE that went up, but all banks for the most part. So now it's at a 10 times PE ratio, which is pretty average for what we see for the banks in our population, although over the past week this PE ratio has gotten a little bit higher, right, as we're seeing a lot higher prices for the banks, and the earnings yield for 10 PE ratio is about 10% earnings yield, which is pretty average for what we've seen over the past year. I'm going to the statistics page, see the 494 million market cap, and we've also got a price to book of about 0.95, which is pretty average as well for where most banks have been before this recent run up. So the bank is priced pretty average on its earnings and its book value. It's also got a pretty average return on assets. That's about average for what we typically see. And then return on equity, 9.62%. So we've got a pretty average profitability bank at a pretty average price, it looks like. And once we start diving into things, we can see if that's the case and whether we expect that those earnings will continue into the future. And so what we have is the first quarter 10Q, and they've recently announced the earnings for the second quarter. But since the 10Q has a lot more information in it, we still run with the 10Q. But later on, we can compare the earnings to what the recent second quarter announcement was and see, is there any big changes, or is it still kind of in line with what the first quarter was, that type of thing. So, well, let's get going through it. We can see the balance sheet here. Got cash of about 300 million. That's pretty average, about 5% of the assets. The securities, if we look at the available for sale plus the debt, held to maturity securities comes to a little over 12%. That's pretty average. We've also got some loans of about 4.4 billion. That's 76%. That's about average as well. 75% is usually, where we see somewhere between 70-75. So that's pretty common to see about 75% loans. And yeah, so we've got a very average asset side of the balance sheet. If we were to look at the leverage, it's about 10 times equity, so 5.8 billion divided by the equity is about 10 times. That's pretty average as well. So really nothing unusual about the asset side of things. And so then we would expect an average net interest income, perhaps, or at least interest income. So coming down to the liability side of things, we can see non-interest bearing deposits of about 750 million. That's about 14% of liabilities, which is a little bit on the low side. We typically see somewhere between 20 and 25%, and of course we would want to have as many non-interest bearing deposits as we can get. So, that would mean perhaps they've got a little bit higher interest expense than most banks if they're having to pay interest on more of their deposits, right? They do have a really small amount of debt though. So these subordinated debentures and notes comes to about 2% of the liabilities. That's really low. We would normally see 5 to 10% of their liabilities being in certain debt. So the rest of it, most all of their liability side of their balance sheet is in interest-bearing deposits. It looks like most of it in savings account. It's about 82%, the interest-bearing deposits. So that's really going to be the driver of our interest expense, right? And so here we see the preferred shares here. And, it's a small amount, but, there's definitely a part that comes out of our earnings. You can see, $1 million here of preferred dividends, and that's about 10% of the net income, right? So it's pretty substantial amount for us to keep in mind, right? All right, so we've got interest income about $78 million. It's about 5.75% of assets, which can be pretty common for this first quarter financials. We're kind of usually seeing something in that range. Over the past year, it would have been a little bit less, right? But as rates have increased, then the average has gone to somewhere around, in the high fives. And we've got the loan interest income about 71.5, which is about 6.5% of the loan balance, and that's a pretty good yield. That's high up there even for this quarter. So earning pretty good money on their loans. And then the securities, about $6 million. It's about 3.5%. That's a pretty good yield on the securities as well. So in some cases we could see some earning still in the 2%. So depending on when they bought them, right? So they're getting a pretty good average yield on the assets. On the liability side, they've got about $31 million of deposits, which is about 2.5%. That could be pretty average for this quarter's financials. It's a little bit higher than it was over the past year, but interest rates have increased since then, and most of their deposits are in savings accounts. So those have increased with the increase in interest rates. So it puts us at about 2.5% yield on their liabilities, which they're having pay, which is it's not too bad actually. It's pretty. It might be a little bit on the low side compared to what we would see for we've seen several banks lately that are in the threes. So all that together gets us at about $45 million. That's about 3.12% net interest margin, which is it's pretty good. It's pretty good yield. So we would typically see somewhere between 2.8 and 3.10. So 3.12 gets us a really good net interest income. And coming down to the non-interest income, we've got about $9 million, and that's about 10%. That's pretty average for what we would see for most banks, and it's good. They've got the wealth management services that gives them some extra income as well, so they fare better than the banks that don't have the wealth management type extra income, right? So coming down to the non-interest expense, we've got about $37 million. It's about 43% of the revenue, which is pretty average as well. So we would typically see somewhere between 41, 47, 48%. So very average amount of non-interest expense. Although lately we've seen a lot of banks that have a lot less non-interest expense. So, but pretty average. And so then we come down to net income of 12.6, which puts us at, after the preferred dividends, puts us at 11.5, and that is a return on assets of about 0.81%. So we typically see somewhere between 0.8 and 1.05 for return on assets. So it's within the average range of what we would see for most banks currently, but it's a little on the low side, right? So if we compare these earnings to the market price currently, which was 494 million for the company, and we annualized it, so multiplying it by 4, it puts us at an earnings yield of about 9.5%, which is within what we are normally looking for. We're looking for somewhere between 9 and 11%. So it's within the average, but a little on the lower side. So, but we've also seen a big run up in the prices of the banks over the past week, so that's decreased the earnings yield for most all banks, right? So this 9.5% yield right now could be a pretty good yield for this bank, and that would mean maybe a pretty good price. So we can start going through all the risks and the financials and the footnotes and the MD&A and see, would paying this particular price be a good deal for us. So we can see that the company, its bank is CNB Bank, and it's got locations in Ohio, New York, and Virginia. So it's located in that geographical area. If we come down to the securities, so they've got available for sale securities plus held to maturity securities, so we can kind of look at those together. The held to maturities are GSEs and then mortgage-backed securities, so those would basically both be riskless. The available for sale securities, most of them come down to mortgage-backed securities here, which isn't uncommon for most banks. They do have some more municipal securities, which is about average for what we would see for a lot of banks. So nothing really unusual around the allocation of their securities portfolio. They do note that they haven't recorded an allowance, and there's not a credit impairment in the securities, so seems to be a reasonable credit risk in the securities. And that makes sense to us. They've got a few more, there's no indication of deterioration in the securities or the institution. And they've been receiving the interest payments as scheduled, so really nothing to worry about with them so far. But, of course, our balance sheet is 75% of loans, so, we're going to look at the loans a little bit more closely. And so they provide a little bit more granular analysis or presentation than what we would see for most banks. And so if we piece this all together and kind of summarize it in the normal categories, we would see that they've got about $1.4 billion in commercial real estate, which is about 31%, and then adding some multifamily of about 248, that's about 5% of the loan portfolio. So those things are pretty average together. The 1 to 4 family is about 24%, which is a little bit on the high side, but not too far outside the range. They've got some normal CNI as well. So it seems like their loan portfolio is sort of a normal average allocation, so we wouldn't expect anything that's outside the norm as far as like yield or credit quality or anything like that. Just looking at this from bird's eye view. So then they've also got their allowance for credit losses here, which is about 46 million, and that's a little bit on the low side. It's about 1.04% of loans. We would typically see something like 1.10 to 1.25%. So 1.04 is a little bit low, but not that unusual to see. And the individual allocations to each of the categories wasn't that unusual either. There's nothing that really stuck out. So coming down, we can see the non-accruals as well. So we've got about 29 million of non-accruals, and that's about 0.65% of loans, and it's a little bit on the high side. We would typically see something between 0.3 and 0.5%, so 0.65% is a little bit high, but not that unusual to see. at least lately, we've started to see a little bit higher past dues and non-accruals for most banks out there. Collateral dependent loans, 17 million, plus this 7.7. So that puts us at about 25 million. That's a little bit on the high side as well. It's about 0.56% of the loans. So far, we've got non-accruals and collateral dependent that are a little bit high. And past dues come to about 19 million, and that's really low. That's about 0.43% of loans. We'll typically see somewhere between like 0.5 and 0.8, so pretty low amount of past dues, which is great. And for loan modifications, not a whole lot of loan modifications either, which is good. Alright, so now we're into the classifieds. So these would be substandard, doubtful. This tells us which ones are inadequately protected by the current net worth or paying capacity of their customer. And it's well-defined weakness, so these are the ones that we find, maybe you're at risk of not being paid back in full. So we usually add these up. And if you remember, the allowance that they have in place, the reserve, is about 46 million. And so already in the commercial loans, we see 101 million of classified loans. For most banks, we see that they've got a reserve that's at least as much as the classified loans, but in this case, it's less than half. And this is just the commercial loans. They, kind of analyze more of the consumer loans separately based on whether they're paying or non-performing, which is here. So we've got another 7.8 of classified loans. So in total, that puts us at about 110 million of classified loans, and that's a lot. That's basically double what we would normally see for a bank. I mean, we normally see somewhere between 1.10, 1.7% of loans being classified, but for this bank, we're seeing 2.5% of the loans, and that's a lot. And this would perhaps signal that there could be issues in the future with past dues or more non-accruals, or some reason that they might need to increase their reserve soon. And so if you compared these to the individual categories, you've got the commercial real estate. There's about 3% of the commercial real estate loans that are classified, and then there's about 6% of the CNI that's classified. So those are pretty high percentages. I mean, 2 or 3 times what we would normally see for most banks. So yeah, so it seems like there's a lot of risk in the loan portfolio currently. And what we would typically do is compare the reserve to the past dues, to the non-accruals, to the classifieds, and see, do they have a reserve that matches the past dues or non-accruals that's sort of in line with where other banks have their reserves compared to those components, right? And for the classifieds, we've already seen they've got a reserve of 46 million, but they've got classified loans of way more than that, right? 109 million. So they've only got 42% of the classified loans covered by reserve. And we would typically see for most banks, they've got 90% to 150% type of thing. So I feel like that eventually might need to increase their reserve, which is of course going to hit our income statement. Compared to the non-performing loans, which would be the non-accruals plus 90 days and accruing plus OREO, foreclosed assets, that ratio of reserve to non-performing is only 150%. And we would typically see something like 250 to 450%, something like that. And so the reserve seems to be a lot lower for that compared to what other banks might, their reserve adequacy would be. So like makes me think that, perhaps we should ding them for their credit risk. So we'll keep that in mind as we go along. All right, they talk a little bit about the borrowings here, which remember they've got a very small amount of their balance sheet as borrowing, so really nothing to, or not a whole lot to talk about here. They don't have any FHLB borrowings, which is pretty unusual. They do have about 20 million of trust preferred securities, which will be at floating rates and usually last somewhere to the late 2330s, something like 2037, 38, 39. Most banks have them lasting till then. But they've also got some, so here they talk about it, 2037. Yeah, they're at floating rates, so it's only $20 million, so not that big of a deal, but keep in mind that as interest rates go up, keep having to pay more and more interest on them. Subordinated notes, they have about 85 million of fixed to floating rate notes, which reprice to floating rates at 2026. So still got a year or two before they will reprice into higher rates. But in the meantime, they're yielding only 3.25%, that's a great yield. All right, so continuing on. Nothing really out of the ordinary in stock-based comp. Derivatives, they don't have any hedges or anything, so there's really nothing to note or calculate or figure out there. They just have the customer back-to-back swaps, which isn't that uncommon. Yeah, derivatives on behalf of customers. So they basically enter into a swap with their customer, and then they have an equal but offsetting swap with another financial institution, so the net effect is zero on the books for the most part. So really nothing to consider or think about there. And now we come to the fair value measurements, which is important to us. We usually look at what is the carrying amount of the assets on the balance sheet, this is what they show on the balance sheet. And then we compare that to the actual fair value estimate of what's the assets and liabilities, and determine what, is the market price of the company cheap or expensive compared to that net asset value. And also from a capital adequacy standpoint, do they have a good fair value amount of equity capital related to the assets, right? So held to maturity securities typically have a difference in fair value. So 381 versus 352, that's about 30 million. And then loans also, which looks like has a difference of about 100 million. So not too bad of a decrease in assets to get to the fair value. It's only about 25% of equity, which is on the low side of what we would see for a lot of banks lately when interest rates have gone up so much. But also this bank has pretty good loan yields on its books, so it's not going to have such a drastic change in fair value of its loans, because its loans are kind of close to what the market yields are currently, so that's great. And so the liabilities have a little bit of a difference, but not as much, because they've got a shorter duration, so there's not as much of a difference in the fair value. Anyway, putting that all together and doing and the assets minus liabilities gets us the net assets, and taking out the intangible assets like goodwill, etc., gets us a tangible fair value of about 350 million. And comparing that to the market price of the bank, which is about 494 million, about 500 million, which was here, so 494. That gets us a multiple of about 1.66 times. So by buying the bank at its current stock price, you would be getting the fair value of its tangible net assets at about 1.66 times, which is a pretty good price. Most banks that we see right now are somewhere between 1.5 to 2.5 times. And with the recent run-up in the price of the banks over the past week, that that multiple is probably a little bit higher now too. So that average multiple. So really at 1.66 times, it's really good. Even if you look at recent mergers of banks buying other banks, it's usually about 2 times that they end up paying for, 2 times the fair value of net assets that they end up paying for. So a pretty good price. If we did the same thing for capital adequacy purposes to compare the fair value of the net assets to the fair value of the assets, we've got 350 million of the tangible net assets, and then we've got about 5.5 billion of fair value of assets, and so that gets us a ratio of about 6.25%, 6.34%. So that's a pretty average ratio. We would typically see somewhere between 5 and 7%. So it seems like they've got pretty average amount of equity relative to the assets. And if we even looked at more of a traditional measure of common equity ratio, it's about 9%, and that's just based on balance sheet value, so the carrying values before converting to fair value, which is a little on the low side, but the tangible common equity ratio is pretty much right in the middle of the average. It's about 8.28%. We would normally see 7.5 to 9%. So I feel like the capital they have in place is perhaps pretty adequate, and we'll talk about that a little bit later once we get more into the MD&A. But speaking of that, we're in the MD&A now. So, one of the main things we look at is the yields for the securities and the loans, as well as the deposits and debt, to see what they're yielding and whether that's average or not. But the first thing we can look at is this chart here. Not all banks have this chart, so I like to see it when they do. They basically show the term structure of the loans, as well as ones that are fixed rates and ones that are floating rates. So this is really helpful for us when we're considering the interest rate risk of the bank, right? So we consider everything that's going to mature or reprice within the first year as kind of a floating rate. If it's going to reprice in the next year, then we should expect the interest rates to reprice pretty soon, right? And then and so those bulk into all of the floating rates. So it would be this 3,062 billion plus the 140 million of fixed rates that reprice within the next year. But then we've got some that are 1 to 1 plus, and those would be the fixed rates that reprice later. Anyways, putting that all together, they pretty much have loans that are floating rates at 72% of the loan portfolio, and then the fixed rates are about 28% of the loan portfolio. So they're a little more allocated toward floating rate loans, so that would be good for our interest rate risk, right? Because banks are naturally liability sensitive over the long term, and especially lately with the run-up of interest rates, the market yields are a little bit higher than what is on this within the 10Q currently. So if they reprice, they're going to reprice at higher yields, and we'll see it in the next quarter and the next quarter, so on. So most banks that have this table in their financials will show kind of a 50-50 fixed and floating rate loans, but this bank has a little higher allocation to floating rate loans, which I really like because I prefer the banks to be a little bit more asset sensitive, at least in this environment. So I'm glad they provided that. So let's come down to the liquidity and capital resources. We do a lot of our own calculations for this. They also talk a lot about it here. So if we remember from the balance sheet, they have about an average amount of cash. I think it was 5% of the assets, and then they've got an average amount of securities. I think it was like 12%. So those are very average amounts, and those two things come together, and a portion of the securities are going to be pledged, right? So they have about 70% of their securities are pledged. So they've got that 30% difference is our unencumbered securities. So they've got cash plus unencumbered securities comes to our on-balance sheet liquidity. This is money that we can spend or we can pledge to borrow from, and we can get cash really quickly. Anyway, so our on-balance sheet liquidity is about $500 million, which is about 10% of our deposits. And that's a pretty low amount. I mean, we would typically see 13 to 18% of deposits being on-balance sheet liquidity. So, we could say maybe they're not as on-balance sheet liquid as what we would see for the average bank, but they do have the ability to borrow from, based on what they have pledged to FHLB and the Federal Reserve. They've got the ability to borrow some more, and they've also got only about half of their loans are pledged, so they have the ability to pledge more of their loans to get more off-balance sheet liquidity, we would call it. So then, that possibility included with the off-balance sheet liquidity they have here, we exclude the brokered deposits from this calculation, but that gives them about $3.9 billion of on-balance sheet plus off-balance sheet liquidity in our estimate, based on all of working through all of this stuff. And that's about 77% of their deposits, which is pretty average. We would normally see something like 72 to 80% of their deposits being able to be drawn down from various sources. So we feel pretty good about liquidity. Even compared to the uninsured deposits, it's pretty good. Compared to the equities, good. Compared to the commitments, it's good. So even though they've only got about 10% of on-balance sheet liquidity to cover the deposits, they have a lot more ability to borrow from outside sources, and so we feel like that makes it have adequate capital and liquidity. But also we saw that they, converting the net assets to fair value gives them a pretty good amount of equity compared to the assets in general. And I bet they show us, so here's the regulatory ratios. They've got really good regulatory ratios as well. So these are above what we would see for most banks. So even from a regulatory perspective, they've got really good amount of capital in their books. So I feel pretty good about capital. We've also got the yields here, which we like to see. You can see the securities are yielding about 2%. That's really, really low. And it's interesting because on the income statement, I feel like whenever we divided the securities interest income by the securities balance, it got us above 3%. So it seems like the securities aren't yielding as much as we might have expected. Loans are yielding really good, though, 6.5%. That's fantastic. And it's a really good yield. So that gives us a pretty average yield on earning assets. I don't have any problems with that. Yield on the savings account is about 3.5%. As we saw, that's the biggest part of their liability of their balance sheet. So that's probably where we would be most concerned at. 3.5% I think is a little bit on the high side. I mean, I guess for right now and this quarter, that's pretty average. And even on these notes is fairly cheap as well. So so that gives them about 3% yield on interest-bearing liabilities, which is pretty average for this quarter, really. So that gives them about a 3.38% net interest margin, which is pretty average as well. We usually see something between like 3 and 3.5% on the tax equivalent one. So they've, pretty average net interest margin, nothing to Nothing to be concerned about there. Now they've got a lot of the ratios and calculations we talked about earlier. I wanted to get down to, so here's some of the interest rate risk stuff. So it looks like, from this, as interest rates go up, net interest income goes up. So that makes it to where we could say it's a little bit asset sensitive, right? At least from just glancing at this. But we do our own calculations as well, right? So looking at the call report, we can see what's the timing of the repricing of securities and loans and debt and deposits, and put all that together and decide, how asset or liability sensitive is the bank. And, personally looking at the securities portfolio, this bank has an unusually quick repricing of securities compared to most banks. There's about 16% of securities reprice within the first year, and then there's hardly any that reprice 15 years from now, which typically we would see a lot of banks that have some reprice pretty far down the road. 1 to 5 years repricing is about 36%. So there's actually a lot of securities that reprice pretty quickly. So I like that. We wouldn't typically see that with most banks currently. And then as far as the loans, about 35% of them reprice within the next year, and that's pretty average amount. And then 44% reprice 1 to 5 years from now, and that's on the high end. So a lot of their assets reprice quicker than what we would see for most banks. So that's fantastic. That's what I like to see. I prefer them to be a little bit more asset sensitive. But on the liability side, on the deposits, we've got about 83% of deposits reprice within the next year. And that would be like the savings accounts, money market accounts, plus the CDs that reprice in the next year. So since they have a smaller amount of non-interest-bearing deposits than we would typically see, then they have more interest-bearing deposits that reprice really quickly. And so, they do have a lot of deposits, but they don't have very much debt, as you remember. So there's not a whole lot to reprice there. So all that together puts them at a pretty reasonable repricing. But we do have a lot of deposits that are repricing within the next year, and that I feel like that is going to squeeze their net interest income, because if we add up all the assets that reprice, which was the securities and loans, it's about $1.6 billion. But if we add up all of the interest-bearing savings accounts and CDs that reprice within the next year, that's about $4.2 billion. So we have, 1.6 plus 4.2, or compared to 4.2. So we have a lot of liabilities that are repricing in the next year, and the assets don't keep up with that. Not even half. So if those liabilities reprice into higher yields, and the assets do too, then we're going to see a squeeze of net interest income as more liabilities reprice into it than assets do. So that's our risk. I feel like that's a pretty big risk, and the way they calculate this might be a little bit different than the way that we calculate it. But I still feel a little bit iffy about that. So I would probably ding them for interest rate risk. Anyway, to put that all together and to summarize what we want to do about this, we saw that it's a pretty average earning bank, right? It's really good. The bank's making really good money. About 0.81% of a return on assets, which a little bit on the low end of the range that we would see, but not that bad. But given that the earnings yield that the price of the company is currently gives us about 9.5%, which is a pretty reasonable yield, especially so since the recent run-up of the banks over the past week. So, as the prices of the banks have gone up, now the earnings yields have decreased a little bit more. So 9.5% is probably a pretty reasonable amount right now, for a bank of average risk and average growth and stuff. But as we got down into the risks, for instance, the loan credit risk, we saw that the reserve they have in place is less than half of the classified loans, right? So we would expect that the reserve would be at least around up to the amount of classified loans, or at least that's what we see for most banks, right? But in this case, it seems like they don't have a reserve that's up to that amount. So we might have a risk there that they might need to increase the reserve in the future, and that would hit our income statement, right? And then decrease our yield on earnings. From the capital adequacy standpoint, I feel like they've got a really good capital base. We saw that they converting everything to fair value puts them at a pretty average percentage of the assets that they have. Also, looking at the off-balance sheet liquidity, it seems they've got the ability to borrow a lot from the FHLB and the Federal Reserve, so they wouldn't have that. I don't think there's a lot of risk in their capital. They did have a little bit less on-balance sheet liquidity, but they definitely have the ability to maybe pledge some more securities if they need to. But I mean, they've got enough off-balance sheet currently with what they've already pledged, so feel pretty good about their capital. But on the interest rate risk side, it seems like they've got a lot of deposits that are repricing within the next year, and I feel like that's going to put them at a pretty big risk of their net interest income to get squeezed a little bit as those deposits reprice and not as much assets reprice into the higher yields as well. So there's a couple, even though we could buy the bank for a pretty average price, which wouldn't be too bad. Even buying the bank's net asset, fair value of its net assets gives us a pretty cheap deal as well. But we have the risks that they are, going to have to increase their reserve on their loans, which would hit the income statement. And we also have the risk that when the deposits reprice, they're going to get squeezed on their net interest income. And so that's a risk to the net income as well. So buying the bank at a 9.5% yield, I think, is too expensive given those risks that we have in place. So I think we're going to pass on this bank. So anyway, thank you for listening. Definitely let me know if there's anything that we missed or that you'd like to hear in the future, or if you have any comments at all, just let me know. Thank you for listening. See you for the next one.